This is one of the most common trading mistakes that traders are making day in and day out, and I can guarantee you that almost nobody is talking about it. The question is, do they really know about this mistake and they don't want to talk about it, or are they trying to cover something that lies underneath that? By making this video, I took into consideration a couple of factors. First, my trading experience, and then second, a real life trading example that gave me 10x's, and why and what has allowed me to get to 10x trades without doing what most of the traders would have done, what actually helped me to protect this trade, be able to run into 10x's. This is a video that I would like to explore in more details this particular trading mistake that a lot of traders would have done and would have prohibited them from reaching their targets. So this video is for you guys. So here is what usually most beginner traders are doing, and this is something that kills their results by a mile, guys. So what you're usually starting a trade with, let's say this is a short trade, so you always will have a stop loss, or in the majority of the cases, I don't really want to overgeneralize like that, but let's say you have your entry here, and this is your entry, and then this is your stop loss. So what happens in the majority of the cases is that when the price starts going lower, at some points this stop loss has been moved either to match entry, so this will be a break-even trade, or to take a small profit here just under the entry. And in reality, what happens is that price never moves in a straight line, so price will never go straight down and then give you 10x's or hit your targets. What happens in reality is that the price is going up and down and up and down, and many times, especially when the price not strong enough, it will need to pick up more sellers. If this was a sell order and this is a pivot level, the price will reach this level multiple times, and there will be a time when the price will go very close to your stop loss and even hit your stop loss, and this is when most of the beginner traders will get stopped out. Unfortunately, I've seen this in practice more times than you can imagine. 90% of all beginner traders are doing this mistake. So instead of that, guys, this is what most traders should be doing. I'm not hiding it, it's just very obvious, but for a lot of traders, it's not obvious at all, and they're acting more out of fear than out of reason. So instead of moving your stop loss to match your entry or below your breaking points, try to do this experiment for 1 week. If you want to switch to a demo account or just keep on reduce your lot size, but do this experiment. Don't move your stop loss as long as you have a very high probability trade and a strong pivot level. Just try to leave your stop losses in the same exact spot where they are. What usually happens is, if this is a strong reversal or continuation point, let's say you are in a short trade here and this is against the trend, if this is a strong reversal point, then what might happen is, if the initial reaction is not strong enough, the price might actually need more time to pick more sellers. Like, you would see the price going higher a few times, and this might take hours or even a day, or depending on which asset class you're trading, depending on your stop loss. If you're a swing trader or a day trader, this might actually take a little bit of time to accelerate the move. And then at the point that the price is actually moving away from your entry, after a few touch points like here, this is a clear indication that you're in the right track. So don't expect by all means the price to move in a straight line. This would never happen. Markets don't operate like that. Markets need time. They need, more orders to be added to the basket of orders that you've already, added your order at. And simply speaking, this all takes a lot of time. If you look at it from the perspective of being patient, you just need to be more patient without doing anything else. Because the moment you start playing with your initial setup, you start playing with the stop loss or anything else, then you're starting to add more variables, which means that there is higher chance of being wrong. The more variables you add to your initial setup and initial trade, the higher the chances are of you being stopped out. And last but not least, here is a trade I took yesterday and I closed today, and this was a 10x trade, guys. So having said that, what are the chances of this trade surviving if I move the stop loss at my entry or below the entry? Literally zero, because look at this level, guys. So this is where I shorted the DAX. Then the price came back, it went down again. At this point I could have closed the trade at roughly 10-11 axis. The price went up again and it went up again. So if I move my stop loss just under the entry, I would have been stopped out. I didn't do that, so the price continued going lower and I closed the trade at this point here for 1 to 10 risk to reward ratio. So this shows you precisely the same of what I mentioned in the previous slide, that the price needs time, and it needs time to pick up more sellers and to accelerate your move. It never moves in a straight line, or actually very rarely, unless there is some major news, something to move the market. If we're talking about just a regular market environment, it simply takes time for you to reach your targets. In life and in trading, it is usually what you don't do that actually helps you to achieve your targets. So this is what you're avoiding as opposed to what you're trying to achieve to get to your target. So this was a video that was created with the help of a live trading example, and a video that showed you why and how I'm able to hold some of the trades for very large returns by not doing something that the majority of traders would have done in my place. I hope this was useful, guys. I'll see you in the next video. Bye.